Welcome back, everyone. Today, we're unpacking the rise and ruin of WeWork. And man, it is quite the story. We're talking sky-high ambition, immense wealth, and a devastating crash that followed right on its heels. So get ready, because we are going to explore one of the most absolutely unbelievable corporate dramas in modern history.
Okay, let's dive into this. $47 billion. Just take a second to really let the weight of those zeros sink in. This wasn't just some valuation, it was a crowning achievement. At its absolute peak, driven heavily by these massive cash injections from investors like SoftBank, this was the mind-boggling figure attached to a company that honestly, essentially just rented out office desks. So how does a co-working startup convince the world's smartest investors that it's worth $47 billion? That massive number right there, that represents a huge knowledge gap that we're going to bridge today.
Because here is the truly chilling reality of it all. On one hand, you have that extreme wealth, the sheer hubris, the $47 billion peak valuation where the company felt completely invincible. But on the other, total corporate collapse. The contrast here is just staggering. We aren't just talking about a company missing a few quarterly earnings reports, right? We're talking about the total evaporation of an empire. It's basically the ultimate modern Icarus story of flying way, way too close to the sun.
Which brings us to the central question driving our entire explainer today. How does an empire fall from such heights? Like, how do you actually go from ruling the global commercial real estate market to a complete meltdown, seemingly overnight? If you love deep dives into business mysteries exactly like this one, make sure you're subscribed to Explained Empire. Now, let's map out exactly how this happened.
Section 1. Founding and Rapid Growth.
The sheer speed of this company's ascent was honestly breathtaking. Starting at phase 1, the founding. The idea was simple but highly attractive. Create flexible, cool, community-driven workspaces. It wasn't just about renting a desk. It was about the energy, the free beer on tap, the networking. Then we hit phase 2, rapid growth. The company started snapping up leases in prime real estate markets worldwide, expanding to hundreds of locations in dozens of countries at a totally breakneck pace. And this hypergrowth triggered phase 3, investor excitement. As they expanded, a total frenzy took hold. Investors were terrified of missing out on the next big tech unicorn, so they poured billions of dollars in, really fueling the fire. Which finally launches us right into phase 4, the infamous $47 billion peak. It was literally a rocket ship fueled entirely by hyping capital.
Section 2. Adam Neumann's leadership.
You see, Adam Neumann had a singular vision that fueled incredible growth, but it was that exact same vision that laid the groundwork for the ultimate downfall. He didn't act like a traditional CEO at all. He acted like a charismatic visionary. He sold a lifestyle. He somehow convinced seasoned veteran investors that WeWork wasn't a real estate company at all, but rather a revolutionary technology company that was going to elevate the world's consciousness. His distinct, relentless style was the primary catalyst for that extreme investor excitement we just talked about. I mean, he could walk into a room and walk out with billions in funding based purely on his conviction and storytelling, flawlessly blending tech startup culture with commercial real estate.
And this brilliantly illustrates a massive, growing tension building inside the company. On one side, you have unprecedented investor excitement. The money's flowing, the headlines are glowing, the valuation is skyrocketing. But pushing back are the emerging warning signs. The fundamental reality of their business model was highly risky. They were signing long-term, expensive leases for massive office buildings and then renting them out short-term to freelancers and startups. Think about it. If the economy dipped and those short-term renters left, WeWork was still on the hook for billions in long-term rent. The math was incredibly dangerous, but the excitement was so loud it completely drowned out the alarms.
Section 3. Warning signs emerge. Now, what's really interesting about this is that there were fundamental flaws in both the business model and the leadership structure, but they were completely hidden beneath that massive valuation. The valuation basically acted like a shield. I mean, if a company is worth $47 billion, the market just assumes the underlying mechanics must be sound, right? But the clues to the ruin were present well before the crash. The cash burn was astronomical. Corporate governance was virtually non-existent, with leadership wielding completely unchecked power. There were highly questionable personal financial maneuvers too, like Neumann trademarking the word "we" and having the company pay him millions for the rights to use it, or taking out personal loans against his stock, and even buying buildings privately only to lease them back to WeWork. The foundation was cracking, but everyone was just too busy looking at the penthouse.
Section 4. Collapse and failed IPO.
Let's move on and see how this builds into a devastating domino effect. Step 1. Warning signs ignored.
Those red flags we just discussed were continually brushed off by those swept up in the hype. But then came step 2, the failed IPO. To go public, the company had to file an S-1 document, which basically opens its books to the world. And the moment the public markets saw the actual math, the massive billion-dollar losses, and that highly unusual leadership structure, the illusion shattered. The IPO failed spectacularly. Public investors entirely rejected the valuation that private investors had artificially pumped up, which instantly triggers the final stage, step 3, complete collapse. Without that IPO cash, the company just couldn't sustain its massive burn rate. The $47 billion valuation evaporated almost overnight, leading to a frantic scramble for survival, massive layoffs, and the dramatic ousting of its charismatic founder.
Section 5. Lessons from the ruin.
So the crucial point is, for any entrepreneur, business student, or investor, there are really actionable takeaways here. First, unchecked leadership risks. When a single leader has total control and absolutely zero accountability, blind spots become fatal. Second, hubris versus reality. A visionary narrative can definitely raise money, but eventually the fundamental reality of your unit economics will always catch up to you. You simply cannot out-hype bad math indefinitely. And third, the danger of ignoring warning signs. When massive cash burn, blatant conflicts of interest, and structural flaws are just waved away as the cost of hypergrowth, disaster is practically guaranteed. This matters for any growing enterprise because it proves that no amount of investor excitement can replace a fundamentally sound business model.
Which leaves us with a final, pretty powerful question to ponder. If a $47 billion empire can vanish so incredibly quickly, how fragile is the next massive corporate valuation? This story isn't just about WeWork. It's a mirror held up to the entire culture of modern business, startup hype, and extreme wealth. It forces us to ask what we are really valuing when we see these astronomical numbers in the headlines. Is it a sustainable business, or is it just another beautiful illusion waiting for its failed IPO? Thank you so much for joining me on this explainer today. Keep questioning what you see, and I'll catch you in the next one.